Hello there.
Hey, how's it going?
Going well, going well.
All right.
How about you?
Pretty good. Just getting the morning stuff done.
Yep. It's 9 a.m. there, right?
Yep, just about.
Right, bright and early. It's about 12 for me, so I've already gotten through most of my morning stuff.
Yeah, you're you're in the back half of your day.
Almost,
Yeah.
almost.
Well, everybody will slowly get on. Yeah.
Yeah, that's what I
Knock out
figured.
this knock out this email real quick before we get started.
No problem.
Oops. You, you.
Hello, Michigan.
What's up, Gary?
Hey,
Hello,
Pat, nice
California.
to have you.
I was about to say hello, California myself.
Dude, you
Oh,
look like, doesn't he
hello.
look like he's in like an airport hangar of some sort? What is that?
Yeah, it's
And
because
mission
of the view
control, man.
from the ceiling. Yeah, they have those big fans circling slowly.
Oh, I love that. The company, big ass fans. Those are
Yeah,
Hmm.
like billions, dude. I love those things. They move so slow, but they move a ton of air.
Oh yeah. Oh yeah. Especially it helps a lot in the summer, especially.
I bet.
Dude, when you guys have like big like Wolf of Wall Street like sessions in the afternoon to get you guys fired up to make your calls. Like
Sometimes,
see him on the back
sometimes.
in the back there just yelling, rah, rah.
Yeah, Monday mornings, especially. Yeah, so yesterday morning, 10:45 a.m. We have the big huddle.
Yep.
Yeah.
Yeah, it's awesome. It's awesome. I don't think I told you I was having him on, Travis, but he's gonna we're just gonna talk about some pricing and some rate sheets and things like that. I figured just some cool stuff. Actually, I'm interested to learn a little bit more too, but and then some new products that they have. And this Refi 100 thing's pretty cool because he actually sent me a lead and they're doing some work to help us maybe get some business. So that's kind of cool.
All right.
Morning, guys.
Hey,
Hey,
good to see you, Paul.
Good to see
so
you
we've got a
too.
guy in
Uh,
space, and then we have mission control over here.
Yeah, look at that, dude.
Interesting.
All right, T minus nine,
Yeah.
7.
All
Raining
right.
like cats and dogs outside. I know that doesn't mean
Yeah, I
anything.
heard.
Here it means a lot.
Are
I've
you
been I've been seeing
in Decode
videos of
today?
like the LA River like being overflowing.
Yeah. There's mudslides and stuff up in LA. And then Paul, they shut down the pass, didn't they?
Yeah, I looked at my. We looked at our Big Bear House camera, and there's like a ton of snow out there.
Yeah. I think they closed all the schools from Hesperia to
I know.
Snowline and stuff like
Right?
that.
Dude, it's really not raining that bad down here. Like, I know LA's getting beat up, but like, we're not getting much.
We got
Good
a lot of
morning.
rain. Morning.
Was that Elma? Nice.
Yeah.
Morning,
Hey,
Elma.
Elma,
Hi.
how you doing?
It's raining.
Yeah, you told me yesterday.
We need an ark.
It's awesome.
All right.
Yes.
I think we have, the usual suspects. So anybody else jumps on, they'll jump on. So if you want to get started, today we have sat with UWM, and he's going to go over something a little different today. Sat, what are you covering?
So first of all, today what I'm going to be doing is going over just a quick training on how to price out a loan on a rate sheet as opposed to using Easy Qualifier. Now, of course, most of the time, using Easy Qualifier should work out for you and it gives you a good idea of what the loan will be priced at. But there are certain situations where you do want to be able to look at the rate sheet and price out a loan from there. Plus, just a good skill to have.
Absolutely.
Definitely.
You
So you
should be
should
able
be
to
able to
share your
share.
screen, I think, if you
Yeah,
need
you
to.
should be able to share your
Okay,
screen
give
and
me
everything you
one
need to do.
second.
Knowing how to work Zoom is definitely a test to see if you're a good AE or not. Like if you can't manage Zoom, we don't send you much business.
That actually, that is one of the things which they actually, when I was originally interviewing for this position,
Mhm.
they did kind of like test your computer literacy skills. And one of them was kind of your ability to get into Zoom and share your screen, so on and so forth.
They're like, here's a computer, hack into the government and erase my parking tickets, and you're hired.
All
Awesome.
right. So here we have our UWM dashboard, right? So as soon as you log into Ease, this is the screen you're going to see. Of course, I have a long way to go to hit Pro Elite because I haven't submitted any loans this month. Um, but typically what you would do when pricing a loan is you would go up to price a loan up here and you would click on Easy Qualifier, and that'd take you to our online pricing engine. However, if instead you go down here and click on UWM rates, this will actually take you to a page where you can see your rate sheets for the day, and it'll also show you a calendar, and you'll be able to pull up all of your rate sheets from the past couple months, so on and so forth. You can click on the specific day that you want and look at your rate sheets from that day. If let's say you wanted to go back to a previous scenario, or you had a loan that you locked and you wanted to look at the rate sheets from that day. So I actually have your rate sheet from yesterday as of 1:25 p.m. So this is kind of what the rate sheet looks like. So if we zoom in a little bit, you can see that it'll show you the rate and then what the actual price, the base price before any adjustments of the loan will be. Obviously, as the rate increases, the base price gets smaller and turns into a credit. As the rate decreases, the base price gets more expensive. Now you can see that it'll have all of these different kind of products here if you're scrolling down on our rate sheet. So first it'll list all of the conventional products. If you scroll down more, it'll start to go towards all of the adjustments and so on and so forth. Then we start to get into more pricing options. We have our conventional arms, the government products like VA, FHA, USDA, so on and so forth. Then we get into HELOCs. So no matter what product you're looking for, you should be able to find the pricing on these rate sheets. You're just going to have to find it. But let's start off with a general conventional loan. We'll start off with a pretty easy scenario, right? A pretty well qualified borrower. So the way the process of pricing out a loan will kind of work is, first of all, sorry about that. We'll go in here. We'll look at, let's say, a target rate we want to look at, right? Let's say that we're looking at 6.625. You can see here what the base price of the loan is, depending on the amount of days that we're locking it, right? If we're locking it for 15 days, this is what the base price is going to be. If we're locking it 30 days, this is what the base price is going to be. And at 45 days, this is what the base price is going to be. So you can see that pricing is better the shorter the lock period, but that doesn't necessarily mean that it's a whole lot better. Like you can see between these two, the 15 and 30 day, there's maybe a 5 bips difference in the pricing. Once you have kind of this base price before any adjustments, you'll go down to the actual adjustments here. Now, conventional is a little tricky because it has a lot of them. So you kind of have to make sure you're combing through all of these to make sure you're hitting all of them. But let's go through kind of this example that we have. So this is going to be a conventional elite loan, right? The borrower has a FICO of 760. they're looking at an 80% LTV. This is going to be a primary purchase for an attached condo. And the rate we're going to be looking at here is 6.625. So here, if we look at the 6.625, we can see that, okay, the 15-day is actually paying us back. If we're looking at a 30-day lock, which is generally what you're going to be looking at, it's paying us back a credit of 1.237. So I'm going to go ahead and write that down, negative 1.237. Then now once we have this base pricing here, we're going to go down to the adjustments. So here we can see that it's a purchase. Now they have a credit score of 760. And what is their LTV? Their LTV is 80%. So I'm just going to follow along this grid to see where it is. Okay, that's going to be an adjustment of 0.625 or 62.5 bips. So I'm going to go ahead and write that down, 0.625. Now we're going to have to see what other pricing adjustments there are. We know that this isn't a rate and term refinance. This isn't a cash out refinance. One thing to note here is you can see that rate and term refinances, they have bigger adjustments than purchases, and cash out refis, they have bigger adjustments than rate and term refis, because all of these adjustments are based on risk factors, how risky the borrower is or how the particular loan is. The bigger the risk, the more the adjustment. So let's scroll down here to see if there are any other pricing adjustments. Is this a refi 100? No. We're not in New York, Texas, or Florida. We're in California. The loan amount, let's say that this is going to be a 300K loan amount. So we're not going to have any of these actual adjustments here. Or actually, let's put it at 500K loan amount. This isn't a high balance. We know that this isn't an ARM. It's not an investment property. It's a primary purchase, not a second home, not a manufactured home, but it is a condo. We can see that this doesn't apply to detached condos, but this is an attached condo. So I'm going to go ahead and take this along this grid. We know that they are at an 80% LTV. So if you look at the top part of the grid here, you can see we're at the 80% LTV. So that's going to be a pricing adjustment of 0.750. I'm going to go ahead and write that down. So right now what we have is a base pricing of a credit of 1.237, so negative 1.237. We have an adjustment of 0.625 for it being a purchase, and we have the adjustment of 0.750 for it being a condo, an attached condo. And it's not a 2-for-4 unit property, no subordinate financing. It's not using Loan Shield or Track. They don't have more than 5 finance properties, so on and so forth. If we go through the rest of these adjustments here, we can see that none of them are actually going to apply to this loan. So
what about the first-time buyer?
In this scenario, they are not a first-time home buyer. But as Alma said, it's important to note that if they are a first-time home buyer and if they fall below 100% of the county AMI limit, then there are adjustment caps on their actual there are caps on the adjustments that they can have, right? So as we can see, it's 0 right here, which means that a lot of these adjustments will fall off for first-time home buyers. Now, let's see real quick. I was going to say something, but I lost my train of thought. Oh, yes. For the AMI, actually, it's really easy to find. If you just search in Google County AMI lookup tool, either Fannie Mae or Freddie Mac, they both have lookup tools that'll pop up their first couple results in Google. You can click on that. You can either put in a property address or search for a county, and it'll show you the actual AMI, and it'll actually show you what 80%, 100% of it is, 80%, 50%, so on and so forth. So that's a really good option to do if you do have first-time home buyers. So what we have right now for this, and once again, negative 1.237, we have an adjustment of 0.625 and another adjustment of 0.750. So what we're going to do to get this cost, once again, after adjustments, the price of the loan is we're going to just add everything together. So that's going to be 1.237. And we're going to make that negative plus 0.625 plus 0.750. So we can see that after adjustments, the cost of the loan is going to be 13.8 bips right here. Now, once again, keep in mind, if you're going lender paid compensation, then you can go ahead and add in your compensation there, which would be at 2%. So the final price of the loan would end up being 2.138. Or sorry, yeah, 1 second. Yeah, 2.138 because your lender paid compensation is set to 2%. If we're going borrower paid compensation, then this would be the final price of the loan because that borrower paid compensation is as a separate fee. Now, if this was a negative number and we had credits left over, once again, you would just, if this was lender paid compensation, any excess credit from the rate can go towards compensation. So you would go ahead and let's say that this was a negative 0.138. So we had credits of 0.138. After all these adjustments, you could go ahead, just put in your compensation to that, and then the final price of the loan would be 1.862. Now let's do another quick example, but this one for an FHA loan. Now you're going to see that it's a little bit easier to do it for FHA loans because government loans have less of these adjustments on them. So let's scroll down all the way down to where our government products are. So this is going to be a regular FHA loan, right? For this borrower, it's going to be a 30-year loan. They're going to do a 30-day lock. Let's say that they are going for the full 96.5 LTV, or 620 FICO. It's going to be a purchase on a manufactured home. So let's start looking at it. Let's say that the first price we're looking at is actually 6.5%, right? So we're going to look at 6.5. We're going to see, okay, so these are the pricings for 6.5. But one thing to note when looking at either when you're looking at Easy Qualifier or when you're looking at these rate sheets is you want to look for cases of inverted pricing. Now, what is inverted pricing? Well, usually we can see that as rates get lower, prices get higher. But occasionally there are going to be such cases where there's a lower rate that for some reason has a slightly higher, lower payment. So here we can see while we're looking at 6.5, and we can see it's giving us a credit of 1.611. If we actually go down a little bit just to check for inverted pricing, and we look, we can see that 6.250 is actually giving us more credit at 1.769 or 1.719. So in this case, we might want to say, even though we were originally looking at 6.5, well, 6.25 is better for our borrower. It's giving them a lower rate, and there's a better price for the loan. So let's go ahead and proceed with this rate instead. So 6.250, we know that they're going for a 30-day lock. So that's going to do, we're going to start off with a base price of a credit of 1.719. Then let's scroll down to the adjustments. You can see, wow, the adjustments are a lot less than they are in conventionals, right? It's just this block right here. So for the credit score adjuster, let's say they're at a FICO of what, 620. So they're going to fall within this one, which is an adjustment of 1.250. I'm going to go ahead and write that down. And then we're going to look at all of these ones to the right here. Let's say it doesn't fit this one, or this one. Let's see. So right here, we're going for a manufactured home, right? So that's going to be another adjustment of 0.250. And these are all only for VA loans, so they're not going to matter here. So once again, all we're going to do is add our numbers together there. So we're going to start off with a 1.719 719. I'm going to make that negative to reflect the credit. We're going to add 1.250, and we're going to add 0.250. So we can see that after the adjustments, the price after adjustments is going to be a credit of 0.219 because this is negative. And once again, if you're going lender paid compensation, you would go ahead and just add it in there. And if you're going borrower paid, that would be a separate fee. So why is it important to also specifically to know how to go into a rate sheet and look at these adjustments? Well, let's say that you have a borrower for an FHA loan and they're at a 637 or 638 credit score. We know that if they can get up to a 640, that's going to pretty much drop what? 0.75, that's 75 bips, right? On the loan of a difference between that 0.5 and a 1.25 adjustment. So if you're able to go into the adjustments and take a look at that, you can tell them, hey, let's try and do some stuff real quick to get your credit score up quickly within the next month or two. Let's try doing a rapid rescore if we need to, or just get another credit report at that period. And hopefully that's going to save you 75 bips on this loan, which can be a lot of money. Yeah, so there are a lot of cases like that. I've had cases with brokers where we've managed to go back in and save them a couple thousand when it comes to the price of the loan. 5,000, 7,000. I've had one time where it was actually 9,000 as well, just by looking at these adjustments and double checking and seeing if maybe we could get them to the next best kind of like step in that adjustment matrix. But yeah, that's kind of how you go through and price out a loan using a rate sheet. Do I have any questions?
I think I like the other one better.
Yeah,
I'm sorry.
that's why we're doing this. So
It's
I know this
definitely
is
out of my comfort zone, and definitely it's an adjustment for me because I understand about 50% of it. That's about it. Sorry, I just have to work with it, I guess.
No problem. And I'm pretty sure this is being recorded too, right? So you can go back and watch this. If you have any questions about it, you can also contact me and we can kind of go through it together. That's no problem at all. Um, it is part of the reason why, you know, everyone has these pricing engines because no one wants to have to go through each individual rate and add all the adjustments physically and price it out. So in most cases, you know, you'll be using EQ or another pricing engine, but in the case where, you know, maybe something isn't working out price-wise, you want to go in, take a deep dive and see, you know, if you're able to maybe save your borrower some money, this is a good option to be able to do that.
that's awesome.
Makes
That's good
sense.
stuff. You made it, I mean, it's not simple, but you made it make sense. So that's the important piece.
All right. Thank you.
Now, you said that there's a sheet like this for every single day.
Yes.
And how far back does that actually go? Like,
I'm not completely certain how far back it goes. I think that you can look at, I'm pretty sure that it goes back to 2023. Like, I think it's about 6 months.